Despite tariff pressures and concerns, U.S. inflation actually cooled in May. But is it still too early to declare an all clear? Joining us now to discuss what all this means for interest rates and the bond market is Hafiz Noordin, VP and Director, Active Fixed Income at TD Asset Management. Hafiz, welcome back to the program.
It's great to be back.
Interesting. We've been watching the data points so closely to try to figure out, with all this trade turmoil, with all this tariff uncertainty, when's it going to show up in inflation? We have feared inflationary pressures. We're not seeing them. What's going on?
Yeah, so there was, obviously we know that the effective tariff rate has gone up despite, a walk back of the extreme tariff talk that the Trump administration had. So there was definitely a lot of attention on particularly goods prices within the inflation data to see if it was ticking up. And we didn't get that. So, the market was expecting headline inflation of 2.4% year over year. It came in line on a headline basis, but on a core inflation basis, the market was expecting 2.9. It actually only came in at 2.8, so a little bit lighter. And on a month-over-month basis, the miss looks actually larger. The market was expecting 0.3% month-over-month inflation in May, and it came in at 0.1% month-over-month on a core inflation basis. So absolutely, it seems like it's more of the growth slowdown theme that's been happening this year in the U.S. that's been feeding into the inflation data a little bit more recently. And the tariff data or the tariff impact is still yet to show up in inflation. But I think that will come over the next sort of several months.
All right, let's go there. Yet to show up, because I've seen a lot of commentary around it basically just saying, well, some people stockpiled ahead of time to get their goods so they have in front of their customers. They don't want to raise prices on customers because of the sensitivity around the cost of living. It all seemed to add up to me that, yeah, it was fine to say this for the month of May, but we got to start looking in the months forward and try to figure out where we're headed. Where could we be headed?
Yeah, and to a certain extent, the market's already priced some of this in. The thinking is that, right up to now, there's been a lot of front loading of purchasing. So there's a lot of inventory sitting out there that is kind of pre-tariff inventory, so it doesn't reflect higher prices yet. But when the market's been looking through the numbers, it's pricing in inflation on a core basis. And I'm particularly using core PCE, which is the one that the Fed looks at when thinking through policymaking. Core PCE to kind of go up and peak at around somewhere between 3 to 3.5% by Q3 of this year. And so it's got that's what's already baked into the market. And I think over the next several months, everyone will be watching to see, are the numbers truly trending in that direction, or are they a little bit worse or better? So I think, there's already a certain amount of expectation that, yes, goods prices will be going up a bit. But I think the Fed is kind of looking through all that. So inflation expectations, longer term, still haven't been really impacted a lot by tariffs.
Fed's obviously under political pressure to cut rates, and perhaps by a sizable amount. The Fed has basically said we need to wait and see how all this plays out in the economy. When you get inflation reports like this, how difficult does the Fed's job get? When it seems like, so we're still above target, but we're not having these pressures. How hard is it for them to stay the course?
It is difficult in that, we know from the post-COVID experience that what may seem like a rise in prices that seems temporary. We get that sort of dreaded word,
transitory. Not transitory.
They're going to make sure not to use that word again, right? But we know that there's always some amount of uncertainty of whether the economy and households view an increase in prices as permanent or not. And whether that impacts their own inflation expectations. And that's very difficult to measure. And so I think that's the part where, having learned from that mistake a few years ago, they're going to tread carefully. And that's why, while many central banks, developed market central banks, have cut towards basically what they would call neutral, the Fed is still sitting out there, only having cut about 100 basis points. They're still at a 4.5% policy rate, which is well above their estimate of neutral. And so I think that's where the tension is there, that you have the Trump administration calling for, at least getting back to neutral. But, with inflation and, as I mentioned, core inflation still expected to rebound to 3 to 3.5. It's hard for them as an inflation targeting central bank to necessarily cut aggressively. So the data will have to, really guide the path for them.
That's what the Fed's trying to make of all this. What's the bond market making of all this?
Well, today, certainly the bond market reaction is pretty positive. You have about a 6 basis point decline in 2-year yields. That basically reflects a modest increase in the probability that the Fed can cut later this year, start getting back towards neutral. But when you kind of step back and look at what's happened year to date with bond yields, Two-year yields are down about 25 basis points from the beginning of the year, again, reflecting a bit of this lower growth in the US. But 10-year yields started the year about 4.5. When all is said and done, we're back to still about 4.5%. And longer dated bond yields are actually up a little bit, about 20 basis points. So, it's really this environment we're in is that, a slowdown in growth is expected, inflation expected to come up a little bit, but it's not translating into aggressive rate cut expectations quite yet. And so I think the good thing, though, for the market, for the equity market too today, is that at least bond market volatility has come down a lot from, tariff talk being walked back. And the fact that inflation is at least behaving right now is helping to maintain bond volatility at these more subdued levels.
If we want to bring it back to Canada, obviously we have our own economy, we have our own issues, but I've often heard over my career of doing this finance stuff that we import bond yields. I mean, the American situation, how much is it press on our situation?
Yeah, and so it's, the movement in bond yields this year has been fairly similar. I mentioned kind of the 10-year in the US, kind of where we started. Canada, similarly, about 3.2, 3.3% is where we started at the beginning of the year. That's where we are today. I think the main difference, though, in where we think of Canadian bond yields going forward is that the Bank of Canada has already cut about 225 basis points from their peak, while the Fed's only cut about 100 basis points. That really defines kind of the big difference in shorter dated bond yields, where the market's pricing in that the Bank of Canada is already kind of close to its ending point in terms of bringing policy rates back to normal. And so I think that's what really will define the outlook going forward is, we may see Canada bond yields a little bit more stable in the front end, while US bond yields may have some room to come down more, if inflation continues to, behave. And so I think that's really, the key difference between the two economies. But there's still always going to be some amount of correlation, I think, between bond yields in US and Canada.
We take Canada against the US, does that mean now that there's more opportunity in US fixed income as opposed to Canadian?
So, it's a great question because, at a headline level, we see these higher yields there, right? Like 4.5% US 10-year versus 3.2, 3.3% in Canada. But one of the biggest things that have changed because of this divergence in monetary policy between the two economies over the last year, the cost of hedging the US dollar back to Canadian dollar has increased substantially. It's about 1.5% per year in terms of your cost in terms of yield. So that 4.5% US 10-year, after you hedge it back to Canada, on a yearly basis is more of a yield of around 3%. So you actually still have a higher yield in Canada after factoring hedging costs. And so I think as investors, we have to keep that in mind that it's not just about the headline yield, but currency volatility has been a big theme, and that translates into real hedging costs. So for now, it still means that I think Canada, and particularly shorter dated Canada bond yields, are a good place in terms of low volatility and pretty decent income.